Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news again with, of course, the only Nick Bendel.
I am so happy to be with you, Owen. I am joining you from Sydney. Whereabouts are you?
I'm still where I normally am, but on this day, it's we are recording this in advance, so I'm still in a very cold place.
So
Looking forward
you're
to probably at this point, looking forward to some warm weather.
so you're in two places at once.
Yes, I am. I am sort of. Yeah, but that's modern technology. Don't ask me how to explain it.
Okay, and the weather is cold at the moment.
Yes. It will most likely be very cold.
Last week, I recommended that you wear some thermal underwear. Did you take my advice?
I'm sure I would. But yes, we'll wait and see.
Okay, we'll have to. People will have to just keep listening to the podcast to find out if you did indeed wear thermal underwear. Uh, that has been it's such a great cliffhanger. I know if there's anything that's going to bring people back, it's to find out the answer to that question.
All right. Yeah, I might be able to get photos if you really need proof.
Okay, well, I look forward to it, and I'm sure others do. Now, for those who who didn't fully understand what we've been talking about over the past couple of minutes, we're recording this podcast several weeks in advance to cover for a family holiday that Owen is taking. But Owen, at this point in the podcast, we usually ask what we've been up to in the past week. And I actually know what I've been up to in the past week, even though I'm now speaking in the future.
Right. Okay. So, what have you done this past week, Nick, that you know that you will be doing?
Well, I gave, notice the past tense, I recently, over the past few days, gave a speech to a group of accountants about how to get media coverage for their business.
Cool. And accountants do need to know how to get more attention for themselves.
Well, I think so. They do really good work. I've got a fantastic accountant I've been using for the past 5 years for my business Hunter and Scribe and also for my personal taxes. And I would love it if his business got more clients, and I would love it if all the great accountants out there got more clients.
Cool. Um, well done, Nick. I know you do great work. You do great work for our business and many other businesses I've referred to you as well. So, um, and what are we talking about today? It's something special?
Well, it is something special because we're recording this podcast several weeks in advance. So rather than discussing recent news stories as we usually do, we're going to have a more general discussion around property prices, which of course is something that Australians obsess about. How do you feel about that?
Yeah, it's something I can talk about. So, hit me with it.
Okay. Now, there are two groups of people out there. You've got your property bears and your property bulls. Your property bulls, of course, are bullish about what's going to happen in the future, but the property bears, not so much. Can property prices keep growing at their current rate forever? The bears say no. What do you say?
Well, property prices will never keep on growing at the same rate um, forever each year. Yeah, there's peaks and troughs, and then there's flat periods, and yeah. So, but will property prices generally over time keep on growing? It's just like, well, yeah, there's no reason why it won't.
Okay, well, let me throw a counter argument at you. Over the past 100 years, if we were to make a very rough estimate, we might say that property prices have grown by an average of, say, 6% per year, while the economy has grown by, say, 3% per year. So property prices have grown about twice as fast as the economy. And if that were to continue, the time would come when the value of the property market was greater than the value of Australia's GDP. presumably that would not be possible, which seems to suggest that the rate of growth we've seen over the past century can't continue forever. This is an argument I've heard others make. What do you think of that argument?
Yeah, well, there's two factors that control any market, as we've spoken about many a time, and it's the old supply and demand. And if and there's a couple of factors that drive demand. It's number one, population growth. If we've got a growing population, then we'll always have a higher demand for housing, which will put up, which will put pressure on prices to increase. And then we've got economic factors like high employment. If we've got full employment, then people are confident about spending money and investing and borrowing money. And then we come to the borrowing money. If interest rates are fairly steady, maybe on the lower side, then that's going to allow people to be able to borrow money and invest in property. So it's but if there's not a demand for housing for people to live in them, especially on the rental side, then people aren't necessarily going to want to invest in housing. So it's a marketplace. So as long as all of those factors are in play, then we're going to see the housing market continue to grow. You can't look at statistics alone. You can't look at two statistics alone side by side and think there's the only correlation is going to be between those two, and that's what's going to determine it. So just looking at GDP figures and the housing market values alone, it isn't going to determine whether property prices keep growing forever.
I'm a property investor, so I guess I'm on the bullish side of this argument. But I want us to look at both the bull case and the bear case for Australian property, starting with the bull case. So let's say, Owen, we were chatting 30 years from now, and it turned out that prices had continued growing at their historic rates between 2024 and 2054. So what are the reasons why prices would have continued to grow during that 30-year period?
They'd continue to grow if we've got a healthy economy, number one. If we've got population growth, number two. And then, of course, number three, and what it all comes down to is we've got the demand for people to be able to need to live in property, whether that is as owner-occupiers or as tenants. So the demand for housing, whether they're tenants or owner-occupiers, it's one in the same, really. So it's no different. People try and separate them as two very distinctive different markets, but no, it's the housing market in general, which is the demand for people being needing to put a roof over their head. And so that demand will determine what the values are. Now, based on that, we then need to look at the supply of housing, and that eventually will determine the value in that 30-year time frame of properties at that point in time, because it's the supply and the amount of supply that will restrict house prices going up and rental prices going up. So that's the only thing that will stop the demand from pushing prices up. So whether we're talking about now or in 2 years' time, in 5 years' time, or 30 years' time, all of those demand factors will always still be there. And the only one way of fixing the problem is supply.
Hmm. Okay, so we've been talking about the bull case over the past couple of minutes. Let's look at the bear case. Let's say we were chatting 30 years from now and it turned out the prices in 2054 had increased by no more than inflation over the past 30 years. In other words, had not recorded any real increase. What are the reasons why prices would have stagnated during that 30-year period?
Well, the exact opposites of the factors I just talked about in terms of demand. So if we've had um, a lack of population growth, if we've had an economy that's stagnated, where there's a lack of confidence, being able to in employment and being able to borrow money, and then um, and then if we've got an interest rate environment, which in that case would be we would expect interest rates to be fairly low. But in recent cases, recent times, there are instances where we can have higher interest rates and high inflation at the same time. So that's where um, that would add more uncertainty to the economy, and which flows through to the housing market. But the big factor there would be a lack of population growth. All those other things aren't as important as the population growth.
I mentioned before that I'm on the bullish side of the argument. Whereabouts are you?
Um, I'm fairly agnostic. It's because we don't know what we don't know. It
Hmm.
it it's I would like to see steady, sustainable increase in property prices. Um, Maybe just ahead of inflation, maybe a little bit, um, and because that way it's sustainable.
Mhm.
And if things are sustainable, then we can live with it for a long period of time. And it means that we can look at the next 30 years knowing that if we do X, Y, and Z, everyone will be able to have a roof over their head, which will lead to a healthy economy, a healthy society, and we can all live harmoniously. Now,
Hmm.
whether that's realistic or not, it doesn't really matter, because that's what we all want. Um, and we all want to be able to live in a good society that's harmonious, and everyone's got a roof over their head. But how we get there is will determine whether it's successful or not. And the way to get there is with good economic policy of limiting demand when there's not enough supply, and at the same time in trying to increase that supply to be able to meet the demand that is there. So that's the only way of dealing with the problem.
You are always the voice of reason and moderation. So I think you're probably the right person uh, to throw these next set of questions at. Um, I'd like to take a critical look at both property bulls and property bears, starting with the bulls.
Okay.
So property bulls tell you that property is a fail-safe investment. Prices will keep rising forever, and you can make extraordinary amounts of wealth through property. I'm wondering, what do the bulls get right and what do they get wrong?
Um, the we, we we need the bulls to be able to drive economic growth, to be able to drive investment, to be able to drive new supply into, because without any of that, we won't reach our goal of meeting demand. So without them, we can't get to where we need to be. Without that investment, without that positivity in the marketplace of investing in new builds, in new developments, we'll never be able to meet the demand issue. And that's where, you know, the bears who are negative about the market and want to control everything to be able to fix the short-term solution will ruin the long-term benefits of being able to fix the problem long term.
Do you think that so you mentioned we do need the bulls, and I see your point. Do you think they're maybe a bit optimistic as to what to expect from the property market?
There's nothing wrong with optimism. Whether it happens in reality or not is for them to live or die by. It's and if they're the ones putting up their money, putting up their capital to be able to invest in it in something, then I hope for their sake it comes off. But they're investing in our economy. They're investing in the housing market to provide more supply, which will help solve the problem. So there's nothing wrong with that.
Okay, well, let's have a look at the opposite side of the equation, the property bears. Property bears tell you that property is a terrible investment because prices are in bubble territory and it makes no sense to buy an asset that produces negative cash flow. What do you think the bears get right and what do they get wrong?
Well, they probably get it right for their own situation, and like it's and if they don't feel comfortable investing in something that might have a negative cash flow, then they should invest in another either in another type of property. If they still want to invest in property, there's plenty of property out there with positive cash flow. You just need to know how to find it. And it's but it might not have as much capital growth. There's usually a trade-off somewhere, or potential capital growth, or it could have both, and that's where. But there's fewer of those types of properties, so they just need to be a little bit more positive in their searching ability and doing the due diligence on the right type of investment that's for them. But if they're just out there blanket saying all property investment is bad because of X, Y, and Z, then they haven't done their homework. So it's they're not really talking from a point of view of being knowledgeable and being active in the market.
Well, great chat, Owen. I want us to bookmark this episode. Let's come back in 30 years' time and
Okay.
we'll see how accurate your commentary turned out to be.
Yes. Well, I think one way or another, I will be right because it's because my point to all of that is the market will determine what the prices will be depending on what the market factors were at the time. And we do have an ability to play with those levers on the market to determine to help achieve what we would like to see what happens. So we just need to all accept what those levers are and start focusing on just those.
And if I was to ask you in 30 years' time, will you be wearing thermal underwear? You'd probably reply, well, it depends on the weather. So I guess you'll be right about that too.
Exactly. Well, thank you, Nick. This has been a interesting discussion, and as always, you always bring the most interesting topics to talk about, and it's very much appreciated.
I will see you either next week or in 30 years, whichever occurs first.
Okay. Well, hopefully it's next week. Thanks, Nick.